everyone, and welcome to another options trading educational video here from OptionsPath. Today we're going to give a quick introduction to one of our favorite options trading strategies, selling or shorting puts. Now this is one of the best ways to build a regular premium income using options while also having the opportunity to buy good stocks or ETFs at a relatively low cost. Now, if you don't mind the possibility of owning a stock or ETF at a significantly lower price than it is now, you could sell or short puts below the current price and earn substantial premium income in a relatively short period of time. For this strategy, you would sell puts below the current market price, which are called out-of-the-money puts. When you do this, you earn immediate income through premium that someone else pays to buy the puts from you. Remember, the buyer has the right but not the obligation to sell an agreed quantity of a stock or ETF, the underlying, to you, the seller, at a certain time, the expiration date, for a certain price, the strike price. Now you as the seller are obligated to buy the financial instrument from the buyer if the buyer chooses, but this only really happens if it makes sense for the buyer to sell the stock or ETF to you. And that's only if the price of the underlying falls below the put strike price. Now the buyer pays a fee called a premium to the seller for this right. Now let's take a quick look at a profit and loss graph of a short put. So we could see from the short put P&L graph here that we have the short put strike price here. Now if the price of the underlying stays above the strike price, then we could see we could get full premium right here. Now if it goes below the short put strike price and then below the break-even point, then we could see that we have losses right here on that premium. Now if the stock price ends up above the strike price of your out-of-the-money put, as I just mentioned, by the end or expiration of the trade, you get to keep the premium you earned from the buyer with no further obligation. If the stock price ends up below the strike price of your put by expiration or the end of the trade, and you don't make any adjustments to the trade, you will get assigned, which means you'll actually own shares in the stock or ETF. But if you're willing and prepared to own it anyway, this is a better way to acquire the stock than just buying it outright because of two reasons. Number one, you still get to keep the options premium you originally received for selling the put. And number two, you will be acquiring the stock at a significantly lower price, the out-of-the-money strike price of your original short put. So there are basically two outcomes for short put trades. Number one, the put ends up above the strike price, thereby being worthless for the put buyer, and you as the put seller earn the premium that the buyer paid you. Or number two, the put ends up below the strike price and you are assigned to buy the stock or ETF at the low put strike price, but you also get to keep the original put premium. Actually, a third scenario is when the put ends up below the strike price and you adjust the put position so that you could earn additional premium and avoid actually buying the stock or ETF. But that's a topic for another video. Now, generally speaking, we like to sell puts on ETFs most of all because of the more diversified risk. But we also sell puts on some high-quality individual stocks when they dip. A case in point might be Facebook or FB, a NASDAQ-listed stock. Now, let's show here the most recent chart of FB, and I'm going to go ahead and pull up my thinkorswim platform. And here we have a daily chart of FB or Facebook. As we can see, it's dipped pretty significantly lately, but we feel it's still a strong stock and company and that it'll continue to be so going forward. So we wouldn't mind owning Facebook stock at a lower price, but in the meantime, we could also make some income without even owning it. So we could sell some puts below the current market price, let's say around the 110 strike price right down here where this red line is. Now, if the price doesn't fall that far by the end or expiration of the trade, we'll just earn the premium without any obligation. But if it does end up below 110, we'll be buying a good stock at a relatively low price of $110. If we were thinking of buying FB stock anyway, this method is much better than just buying the stock outright at the current price of around 119 or so, as we can see here. So now let's finish this up by going to the Trade tab on the Thinkorswim trading platform. Of course, you could use whatever platform you wish, and the process will be very similar. Let's go ahead and go to the Trade tab, and here is the options chain. Now here we would look for an appropriate expiration date, in this case around 30 days out, as we can see right here, and then look for our put strike price of 110 on the options chain right here. Now we would simply right click on the line and go to sell and then single, click on that. Then out pops the order entry window where we could change the number of contracts or other parameters, as we can see here. Here's the current market price for the premium. We could adjust that to what we're looking for, then click on confirm and send, and then wait to see if our order is filled. So there you go, just a quick and simple video on trading short put options, one of our favorite income/stock acquisition strategies. Hope you found it useful. We'll have plenty more instructional videos on trading options going forward on our website at OptionsPath.com. From all of us at OptionsPath, thank you very much and have a great day.